Well, for more on the broader markets, let's bring in Jay Hatfield, CEO of Infrastructure Capital Advisors. Jay, thanks so much for joining us this afternoon.
Thanks, Jacqueline, for having me on.
So I mentioned Fed speakers out in force somewhat this week, sending messaging perhaps to markets or what have you about how they view the future path of interest rates and of inflation in particular. And it sounds like at least some of them are confident in the trajectory of inflation being on a downward trend. How are you interpreting what you've been hearing recently?
Well, we've been calling for really the last 6 months that the Fed would halt their interest rate increases before most people thought. But we also acknowledge that they would basically be the last to know. They like to follow lagging indicators like CPI that has a distorted shelter component in it. So now that's pretty much consensus, and that's really what's been driving the rally in interest rates, even globally, not just in the US and Canada, but globally. And so that's now kind of the expectations. What's at risk, and we're nervous about, is the next Fed meeting, we're gonna have what we call SEP, or the dot plot. And the market is at over 100 basis points of cuts, whereas the last SEP was only 25 from the Fed. So we're a little concerned there could be a disappointment around that. But in the long run, we're bullish because we think Europe and the ECB is going to cut even as soon as the first quarter. They had very cool inflation today, and their economy is really in a major recession, 2.4% GDP now decline. So current estimate of this quarter. So we're bullish about rates, but a little nervous about the Fed meeting coming up.
Yeah, it's interesting to look at the revised third quarter GDP out of the U.S. coming in higher than previously at 5.2% for the third quarter. What do you make of the strength in the U.S. economy at this point? Is that, going to weaken from there? That's a third quarter story, and we're going to see some weakness, do you think?
Well, we're in and have been correctly in the, and I think we spoke about this maybe even a year ago, correctly in the no recession camp, because we look at housing. 8 out of the last 9 recessions have had a huge plunge in the housing sector, but yet in the United States we're getting a little bit higher prices, not enough to hurt inflation, and continued starts of about 1.4 million, whereas the average recession is 900,000. So we don't think we're going to have a recession, but to your point, 5% is clearly unsustainable. A lot of that was inventory build, unsustainable retail sales. So we're forecasting 1% to 2% this quarter and next year. So slowing growth, and that's consistent with our GDP now, which is at the Atlanta Fed, which is around 2. But just contrast the U.S. run rate of 2 plus, and Europe run rate of negative 2.4. So we don't think investors are focusing enough on the implosion of Europe and the fact there's CPI is plunging, because basically the ECB cured inflation by killing the patient. The cancer of inflation by killing the patient. Because it's pretty easy if you invoke a major recession, of course, inflation is going to go down. And so we think that that's the real bull case, is global rate declines, but not led by the United States.
Do you think that Europe gets stuck in that negative place for some time, or is this something that they can, get out of quickly? What do you think?
Well, we're not super bullish about the European economy. They don't benefit from what we have in North America, which is this, incredibly cheap natural gas. So we have an 80% cost advantage over Europe on both electricity, because natural gas prices electricity and natural gas. And we also have an abundant energy sector. So those are big advantages. And also, of course, we have AI and tech in North America as well. So we think they'll be okay once they cut rates. It'll take a while, but we're not really bullish on the European economy. They have slow population growth, lower tech industries, no energy, less efficient capital markets. But we think they'll start to muddle along in their sort of 0 to 1% growth after the ECB cuts rates.
Oh, I mentioned oil prices climbing today, but also this meeting with OPEC Plus tomorrow that a lot of people have been watching out for quite some time now because it has been postponed once. But what would you be expecting to hear out of the meeting? Also, just, more broadly when it comes to oil prices, we have seen them come down quite a bit over the past couple of months.
Well, we're both the most boring oil forecasters, but also the most correct. We've stuck to our $85 midpoint of our target. We said 75 to 95, really the whole year. And if you traded that on a dedicated basis, which is extremely difficult to do, and we don't even do it at our firm, but you would have made a lot of money because when oil got to 95, we thought it was ahead of itself. Then we have the normal seasonal weakness because everybody forgets nobody drives in the fall and they don't heat their homes. So normal seasonal weakness. So we kind of went down to 70. We think the concern over OPEC is overblown because ultimately the Saudis will do whatever cuts are needed to make up for non-cooperative smaller members. So we think that'll be a mild positive. And then as we get into the winter driving season and heating season, we should kind of trend back to this middle of the range around 85 on WTI. So we're sort of mildly bullish on oil and think maybe our target will go up $5 next year.